Hi everyone, welcome to today's presentation, which is about preparing for a new tax year. My name's Adrian O'Connell. I head up the tax team at Blu Sky Chartered Accountants, and I'm joined today by my colleague Steven Robinson, who is part of Blu Sky and will cover himself in terms of his role in the business. Over to you, Steve.
Yeah, so like Adi said, it's Steven Robinson. I'm the CEO here at Blu Sky, and I'm going to be working with Adi here on the presentation today. So let's get in. So a few things on the agenda today. What we'll start with is a few basics. Then we'll dive into the rates and allowances. Adi's going to cover a few things on that. There's a few kind of high level topics that we'll run through, and then we've got a bit of a case study to finish. So we'll run through a few scenarios that we'll see with clients, how we generally approach the situation, and a few kind of technical topics around that. And then we'll look forward into the next couple of tax years and a few kind of high level changes that happen. So I guess from a basics point of view, we'll run through a few key things that you probably need to keep an eye on. So lower rate tax bands, what we'd always say from a client point of view is keep an eye on the tax bands at the lower rate first and use the basic rate band first. So that's kind of up to about 50k. We'll come on the rates precisely in a couple of slides time. But would always recommend using that first. And then they go on to 100k when you jump into the kind of next level, when you start using your personal allowance, personal allowance, yeah. So use those first. It's much more tax efficient, and it's better for the tax rates. Dividends or salary. So from a CT impact corporation tax, dividends aren't allowable for corporation tax, and salary is. But there's kind of still some other things to consider. So from a salary point of view, like I said, it comes off your corporation tax from a business point of view, but you will pay a little bit more personal tax on that. So again, we'll cover that in a bit more detail as we go through. Dividend allowance, you get the £500 allowance there, like it says. Um, but again, there's a few things to consider around that. As you're kind of taking that and it ramps up, you generally want to take the salary first, to get the corporation tax impact. You can take the first 12,570 salary with no national insurance contributions. So that's generally the kind of mix that we'll see, but we'll come on to that again a little bit later. Personal savings allowance. So this is when you take bank interest. So anyone who's lucky enough to have some savings and you get bank interest paid on that, you get the first bit of that tax free. Capital gains tax annual exemption. So that is a use or lose, as it says there. So if you don't use that in each year, you lose it. It's relatively small annual exemption that you get, but if you can use it, then use it each tax year. And then IHT annual exemption, Adi will come on to that in a little bit more detail on the next slide as well.
Yeah. So like Steve said, there's many other basics to think about. So from the point of view of being a business owner, we've got pension contributions. These can be made personally from your taxed income or through your salary, but equally, there's the opportunity for the business to make contributions on your behalf. So, quite often we're speaking to business owners about that. That's a flexibility that other people don't necessarily have, and it's well worth making use of that. In addition to an allowance for the current tax year, if you've got any unused allowances from the 3 prior tax years, you can also make use of them when looking at making a contribution. So it's well worth thinking about what your history in terms of contributions has been and making the most of that if you're looking to make an increased contribution. That's also important in terms of managing your income for other reasons, which we'll come on to later in the presentation. Likewise, we've got gift aid donations listed here. So, I'm sure there's lots of you out there who are very charitable by nature, and gift aid is a good thing to do, but equally you can get a benefit of it or an additional tax benefit if you are a high rate taxpayer or an additional rate payer. Unfortunately, not the case if you're just a base rate taxpayer. So, you can do a nice thing and also get a bit of relief yourself. And again, that can be quite important if you're looking to manage your income, if you're about the 100k threshold. Moving on to that, we've got to think about your spouses. So if you are married, if you are transferring assets between spouses, you can do that tax neutrally for capital gains tax purposes. It's called a no gain, no loss transfer. And in addition to that, if your spouse is working or isn't working, I guess, or if they are a lower rate taxpayer than you are, then potentially if you've got joint assets or you've got assets owned by one of you, you could think about shifting them between you to basically make better use of allowances, or just simply to put more income in one of your individuals' names, basically. So a bit of planning around that can be quite helpful. And then when we think about, I guess, preparing for a new tax year or year-end planning as well, people often overlook some of the simpler things such as ISAs and other tax-efficient investments. Now, I guess tax-efficient investments can be viewed as more an investment decision and a potentially riskier investment. So if we just focus on ISAs for now, these are tax-approved wrappers that the government offer. At the moment, you can put in £20,000 a year across any number of ISAs, whether it's cash or stocks and shares, and the gains or income within that ISA are tax-free. So, they're very much the right thing to look at straight away before you get into any sort of complex or more complex planning. Last point I hadn't mentioned or brought up was child benefit. It's important to be aware that if you earn between 60 and 80,000, that any child benefit that you may have claimed can be clawed back. Essentially, once you earn over 60,000, by the time you get to 80, it's clawed back in full. And if you earn between 60 and 80, there's a sort of partial clawback, depending on how much or how far within that scale you are. Now, child benefit is clawed back if one from either, if you are married or civil partners, if either one of you earn between that 60 and 80, so it's not a household kind of measured income. They look at you as individuals, which can seem a bit penal. We thought the government may unwind that, but they've sort of not chosen to do that at this stage. So again, it's been aware of the potential tax impact of this. However, if you have got a young child and maybe you don't need the income, it still can be worth claiming it because you do get NIC credits. So there are other reasons why you might claim child benefit, if not necessary to actually get the income for other tax reasons. Now, I guess the other point to make at this stage is this presentation is about preparing for a new tax year. Often advisors talk about this sort of in February, March, leading up to the end of a tax year. Actually, I think the way we try and think about it is thinking about your tax situation is an ongoing thing. It's almost easier if you think about it earlier in the new tax year because you've got a much longer lead time into the year end, which might be important from a timing point of view. So really, all the things we mentioned today, whilst it's important in advance for new tax year, probably best to think of at any point, and certainly give yourself as much time as possible to plan around it. The last point is sort of considering the timing of transactions. So, different tax actions have different tax impacts, I guess. If you're approaching the end of a tax year, maybe you can defer something by a couple of weeks to push into the new tax year. That could save the payment of tax by, that can push it back by up to a year potentially. Or likewise, you might want to bring something forward. You might find that where rates increase in a new tax year, it's better to perhaps bring a dividend payment forward, pay a different rate of tax than if rates were to increase. So often off the back of budgets or autumn statements, as they were, if there are any changes that have been put out there, that is a good incentive to look at your situation and think, right, is there a way of either deferring income or sometimes bringing income forward or deferring expenditure? So the timing is always an important factor in any sort of tax plan. The next thing we thought we'd just touch on very briefly, we're not going to labour on this, is rates and allowances. So the key point is actually, I haven't gone back through looking at the current year rates and looking into the next tax year. Actually, nothing's really changing, so that's good in some sense. You've got a degree of certainty. So Steve's already touched on the income tax personal allowance. So it's £12,570. You can earn that amount of income before you pay any income tax whatsoever. So particularly where you've got business owners, they often do draw a sort of minimum level of salary because that is a tax deduction within the business, but won't have a personal tax impact for you. Steve's also mentioned the personal savings allowance. That's the sort of savings interest. So it's £1,000 for a beta rate taxpayer, £500 for a higher rate taxpayer, and unfortunately, if you are lucky enough to earn or suffer tax at 45%, you won't actually get any personal savings allowance. So caught twice in that instance. On the plus side, or good news, I guess, the dividend allowance is something that's available to everybody. So there's no tapering of that depending on your income. It's not as effective as it used to be. It used to be £2,000. It dropped to 1,000. It's now just 500. But that £500 allowance is still here in the next tax year. From a capital gains tax perspective, we've also got an annual exemption. That is, as Steve mentioned, use or lose it. So if you have lucky, or I guess you're lucky enough to have assets, say a portfolio assets sitting at a gain, and you've got some losses, well, you might be able to manage that to get your sort of net gains within a £3,000 exemption. That again is something that has sort of fallen over recent years. It used to be around about 12,000. It dropped to 6,000, and unfortunately, it's dropped down to 3,000. So, whilst a couple of years ago there wasn't necessarily an increase in headline CGT rates, the impact of the exemption falling is capturing more people, unfortunately. We've touched a little bit on pension contributions, so there's a couple of points here to mention. The maximum you can contribute to a pension scheme and get tax relief is £60,000. That is the gross value, so includes any tax relief that's claimed on the contribution, and that also it catches both an employee's and an employer's contribution. So quite important if you're thinking about utilising sort of this relief, that if you're anywhere near that 60,000, you do look at all those different factors and don't assume that you can make a full contribution yourself and say the business can make one on your behalf as well. That's not going to be the case. But if you're making the contribution personally, you have to have what is known as relevant earnings, and we will touch on this a bit later. What it means in simple terms is that if you don't have sufficient earned income, you can only contribute up to like a maximum amount, which is the 3,600 that's referenced. That 3,600 again is a gross amount, so it includes any tax relief. So in terms of the actual contribution you can make, if you don't have a huge amount of earned income, I think it's £2,880 net off the top of my head. It's around that amount. That's what you'll be able to make and get tax relief on. Now we've touched on the different tax rates, or if you're basic rate, higher rate. So what that means is basically on any earned income, which for tax reasons is called non-savings income, or actually any investment income, which again is often referred to as savings income. The basic rate of tax is 20%, the higher rate is 40%, and the additional rate is 45%. And I'll come on to the next bit, where that's caught from a tax band perspective. But as Steve mentioned, dividend income is more tax efficient. So if you are receiving dividend income and you're a basic rate taxpayer, you will suffer just 8.75% tax versus the 20% that's referred to on earned income. Likewise, if you're a higher rate, you'd pay tax of 33.75 versus 40, and additional rate you pay 39.35 versus 45. So there is still a tax saving to be had by earning dividend income, but there can be other tax impacts of that as a result. In terms of what is a basic rate or what's a higher rate, so essentially the basic rate is up to £50,270 of taxable income. Now, if you've got a full personal allowance, so the full 12,570, what that actually means is the difference that falls in the basic rate. So that's £37,700 of income that would be taxed at 20%, and your 12,570 would be taxed at 0. Once you get beyond that 5270, you're into higher rates. So whether that's the 40% or the 33.75%, you're classed as a high rate taxpayer, and that will follow from basically £50,271 up to £125,140. That used to be £150,000, but again has fallen in recent years, so it's capturing more people at that additional rate. And the additional rate now means that if you are earning or lucky enough to earn over £125,141, then you'll be paying tax at the highest rate of tax. One point which we've just not flagged here or we've touched on is the important threshold is once you breach £100,000 of income, if you are between 100,000 and 125,000, the personal allowance starts to taper away. So for every £2 that you're above 100,000, you lose £1 of your personal allowance, meaning that by the time you get to the 125,000 threshold, you've lost your personal allowance in full. And there's kind of an effective tax rate in that band of 60%. You think it might be 40, but if you add the 40% tax you're paying on income plus the personal allowance that's been lost, it equates to a 60% effective tax rate, which is very penal, but unfortunately, there's not really much you can do about it. Really, ideally, you just want to be so far beyond that you kind of forget about it. But when you are between 100 and 125, it does feel a bit unfair, unfortunately. In terms of CGT rates, so again, there's been a few changes on that recently. Since the autumn budget in October 24, the basic rate of capital gains tax is now 18%, and otherwise it's 24%, unless you fall within certain reliefs that are available for business owners where there are some effective lower tax rates, but you have to meet certain conditions to qualify that. So we'll touch on some of that a bit later, but in headline terms, we're looking at either 18% if you've got any basic rate capacity, otherwise you're paying 24% tax on any capital gains that you make. Right. So the next point of the presentation was to think about those were the headline kind of basics, I guess. But within that, there's a lot of other sort of tax issues that it's probably worth being aware of to different degrees of detail. We're not going to sort of fixate on detail on these. It's more just a high level awareness. If obviously if it's something that's relevant to you, it's probably worth inquiring further or looking at further. But a few sort of pertinent points that hopefully will be worth you being aware of. So there's about 10 different things we've listed up here. We've touched a bit on pension. There's been some national insurance changes that'd be worth noting and being aware of. Benefits in kind are always a important consideration for any sort of business owner. But there might be a tax impact for you, but you might be getting some efficiencies within the business. So it's sort of the balancing out between the two. Clearly, if you're a shareholder in the business, that might be a sort of key focus driving the business growth, but there's some important tax considerations to be aware of and some important changes that again came out of the budget that we just want to flag. Capital allowances, so that's basically relief for capital expenditure. Again, it's something that your tax advisor should be claiming for you and making sure that you're getting that relief for any expenditure that qualifies. Now, advanced expenditure, that isn't obviously a tax issue as such, but it's more around thinking about, well, the nature of this conversation, we're talking about preparing for a new tax year. Are there actions you can take in advance of a sort of your accounting year end that would provide some tax efficiencies for you? We've got a bit around inheritance tax, and that leads back into being a shareholder of the business, what that means, and some just general property considerations. So I'll run through sort of, there's probably 10 slides, but we're not going to labour on them too much, just headline points before we come to our case study and think about some of the future changes to be aware of from a tax perspective. Right, so from a pension point of view, it's important to think about, depends where you are in your life cycle, but state pension, if you're paying tax, then you want to make sure you're qualifying as far as possible for that state pension. So there is a requirement to have a minimum number of years, which is 10 years of earnings on your records. But also when you get to 35 years, that's the maximum you can have. So if you are at or near 35, you're in a pretty good spot. What you can do is make additional NIC contributions if you're short of any years, so sort of as a catch up, but you can only go back as far as 6 years. Now, whether or not that's worthwhile, like I said, it depends on how far you are from the 35 years, what you're trying to achieve. So there's no wrong or right, but it's something to think about. So yeah, certainly you can typically access your pension record on your personal tax account. Assume if you have got one set up, if you haven't, go and look at them at gov.uk. That will give you the details, and you can access them quite quickly and give you a view on where you are in that spectrum, basically. But as I touched on before, other pension considerations are about this relevant earnings. So, if you are a business owner and you tend to take your earnings by way of a dividend, or that's how you remunerate yourself, that can cause an impact for personal pension contributions in the sense that you might not have these relevant earnings that I touched on before. So in that case, you may only be able to contribute a maximum of 3,600 sort of gross if you don't have those sufficient relevant earnings. However, as we mentioned, if you're lucky enough that you've got a business and you've got the capacity for the business to make a contribution, that sort of negates that. So it's just been aware that, yeah, you might not have relevant earnings to make personal contributions, but potentially the business can make them on your behalf. You can still exceed that 3,600 figure. Your annual allowance we touched on, so it's £60,000. That can be tapered though, depending on the level of your income. So again, the 60,000 is the maximum, but if you have what's called adjusted income, so that's broadly your earnings less any sort of pension contributions. But if that exceeds 260,000, then your annual allowance decreases by £1 for every £2 you exceed the 260,000 threshold. So what it can mean is, I think once you, again, if you get to this point, you're doing well. But if you earn as much as £312,000, then the annual allowance that's available to you is restricted as far as like the minimum is 4,000. So you can drop from 60,000 all the way down to 4,000. So you just need to be aware of not making excessive contributions, and you find that you might be subject to tax charges and so on. Because if you exceed any annual allowances, you can be subject to tax charges, which can be paid by a pension scheme, but it's still, it's not necessarily something you want to avoid, because if you are exceeding it, you might be exceeding it because your employer could be making huge pension contributions. That's not necessarily a bad thing, but it's just weighing up the two and understanding the tax impact of exceeding your annual allowance. And then I guess from the other point of view, like SIPs, you can also set up SIPs for your kids if you wanted to. So they can also contribute up to 3,600 if you've got spare earnings and you just want to almost start now for their future pension provision. When you've got minor children, you're probably not even thinking about these things, but if you do have capacity to do so, then it's an option that you've got. Right. Yes. So next point is NIC itself. So I'm sure many business owners will be aware of the impacts of what's happened from the budget, that the sort of NIC rate is, or the employee's NIC rate is increasing, and therefore there's a additional cost of employing staff, and in addition to that, the earning threshold is falling, so it's a bit of a double whammy. Many of you will suffer higher NIC costs or might impact staffing decisions, which obviously isn't ideal at times if you're trying to grow your business. But one of the solutions that you may have is to think about salary sacrifice. So salary sacrifice is basically a way that your employees can give up an entitlement to income in exchange for either reward or other type of reward, I guess. So, for example, I've seen it used before for company car schemes, that employees can opt into a car scheme. They effectively salary sacrifice to give up some of their gross pay, and that's used for effectively a car lease that can be effective for both the employee and the employer. Again, by way of pension contributions for staff, that also is a good way of doing it. So, there is likely a cost to implementing a salary sacrifice scheme. So it's not necessarily that it's going to be a free solution, but it's something that's worth considering, and it can help you manage that NIC bill. So that's kind of the main key thing that we've been talking about since the changes. And again, I've mentioned that point about voluntary contributions. That is all about making contributions that go towards state pension entitlement. So if you are short, once you check your record, you can go back 6 years and make those voluntary contributions. So rolling on from sort of salary sacrifice we touched about and car schemes is, or sort of benefits in kind. The main thing we talk to business owners about at the moment is about company cars, and the move from, I guess, petrol and diesel cars to hybrid or electric. We've seen some schemes that only offer electric cars these days. That is great for both the employer and the employee. The employer can get, sort of, if they were buying the car, they can get capital allowances, or if they own the car at least, and that can be very efficient in that sort of first year of ownership. And from a employee point of view, the benefit in kind charge on electric vehicles currently remains still very low. Sort of by way of comparison, it might be a 2% charge on the list price of the car, versus if it was a petrol car as high as 30%. So a significant saving. I guess we're expecting in due course, who knows when, the rates to increase on electric cars, that the government is going to have to collect some of the duty that they're losing from people's behaviour changing in terms of vehicles. But for now, the rates are still low, and as I say, they're very tax efficient from an employee perspective and bring good benefits to the employer. So certainly something worth looking into if you're not doing so already. Shares and business interests. So I guess again, a lot of this does stem from the budget, but previously, if you had shares, or still currently actually, the changes will come in. But if you've got shares in a quoted trading company and you meet certain conditions that qualify for business asset disposal relief, so broadly, if you have more than 5% of the voting rights and ordinary shares in a business, on an exit or disposal of those shares, you would expect to qualify for business asset disposal relief, so BADR, it's the acronym that's thrown around. And under the current rules, you would qualify for a 10% rate of capital gains tax. Now, it used to be more generous because it used to be called entrepreneurs relief, and you had a £10 million lifetime limit. Unfortunately, that fell a number of years ago down to £1 million. So I think a lot of business owners who had, big growth aspirations for the business feel like they've lost out there. But you still got £1 million at 10% versus what could be £1 million at 24% now. So, there's definitely a tax haven to be had. Unfortunately, from April 25, that 10% is moving to 14%. And then from April 26, it's increasing again to 18%. So we've been speaking to people recently about, or who are transacting about the tax differential for them in the change of rates. And they may not be able to transact before April 25, but certainly they want to do it in the next tax year. Therefore, it jumps up again to 18%. In addition to the changes to the BADR, tax rate, there's also been a change in the IHT treatment, so inheritance tax treatment of these shares. So again, typically, if you hold shares in a trading business, this was a very efficient asset for inheritance tax purposes. You would get full relief for inheritance tax. There could be some restrictions to that, but in broad terms, you expect to get full relief. And therefore, those other things you could do with those shares from a tax planning point of view. The budget again is to hit this sort of asset class, and what it's meant is that going forward, the 100% relief that was available is only available on the first £1 million of value. So actually, if you've got shares worth in excess, or a business, if you've got an interest in a business, and it's obviously your shareholding is worth more than £1 million personally, anything above that 1 million value will only attract relief at 50%. So that's a significant change for those who were expecting to rely on that full IHT relief and maybe thought they've only got other assets that might fall within the scope of inheritance tax. Well, all of a sudden, you might suddenly find that broadly, depending on the values of your shares, a significant percentage at least could now be subject to IHT. So that's something to sort of look into, I think, and try and explore what options you may have to mitigate that. Largely what we've seen is in the short term is maybe some sort of life insurance or term cover or something, just to sort of as a short-term measure, I guess. There may be further changes down the line on this, but for now it kind of mitigates any IHT exposure without necessarily taking any drastic steps that you wouldn't want to take in case rules do change down the line. And then the other sort of change was to investors relief. So investors relief is similar to business asset disposal relief, but it's targeted at investors into these unquoted businesses rather than the directors or employees. So you can't qualify for this relief if you are a director or an employee, but likewise, if you meet certain conditions and you've held them for sufficient time, you can get that lower rate of CGT. So 10% currently, rising to 14. But the big change, I guess, that came out of the budget was, whereas the 10 million lifetime limit for business asset disposal relief had fallen to 1 million many years ago, that hadn't impacted investors relief, but now they've aligned the two. So unfortunately, investors relief has now fallen down to 1 million, and that's a lifetime limit. Capital allowances. So again, very briefly, capital allowances it's about getting relief or tax relief for capital expenditure in your business, but this is typically on things such as plant machinery. It's not necessarily the actual buildings itself, because there'd be other forms of allowance available for that. Capital allowance is basically the tax form of depreciation. So depreciation isn't a tax deductible item for tax purposes. It would be for accounts purposes, whereas capital allowances is the relief you get by way of replacement, but there's, I guess, slightly different rules and slightly different approach. So you've got something called full expensing, which is just essentially getting full immediate relief for qualifying items of capital expenditure. You get there's an AIA, that's an annual investment allowance, that's £1 million currently. Again, most capital expenditure can fall within, it could be relieved in that way, and effectively you get up to £1 million relief immediately. Now, obviously, if you've got significant businesses and you're spending lots of money on capital expenditure, that million isn't going to be sufficient for you. But if you've got a smaller business, then certainly that should be more than sufficient, and you get that immediate relief. So that is something that's very useful to utilise, and expect your advisor to do so. And then there are other forms of capital allowances. So I've got the acronyms here. So WDA means a writing down allowance, or SBA is a structured and building allowance. Basically, depending on the type of asset that you've acquired, there may be different rates or rules in which you get effectively that tax depreciation. So you may not get 100% relief in year one. It might be a staggered rate, such as 8% rate that is applied over the lifetime of the asset. So it's really a case of looking at, well, what is your expenditure and what reliefs are available, but certainly make sure that if it is available, you're claiming it, because it's an important tax relief to utilise. Right, I won't move too much more. I'm kind of talking a lot, and we'll get on to Steve's bit, so I'll rattle through these next ones. The advance and expenditure, I guess this is about the timing point. So, if we're approaching an accounting period or end of a tax year, well, actually, what things could you do that could improve your corporate tax position, or could improve your personal tax position, or entitle you to certain relief? So, pension contributions, if you're coming up to the end of a tax year, maybe that's the right time to look at pension contributions, and is there scope to make one through the business? And that would, again, as we touched on a few times, help and improve your corporate tax position, because it's a tax deductible expense, and therefore would reduce the profits that are subject to corporate tax. Likewise, coming off the back of the last slide, is there any capital expenditure that you're planning? Do you want to sort of advance that and bring it into this period and get the relief earlier, rather than deferring it to a later period, or waiting on making that investment? Now, again, there might be good reasons why you're holding off making investment, or it's just a bit of caution in the market. That's all well and good, but purely from a tax point of view, if you brought that forward, you get some relief sooner rather than later. Revenue expenses, I guess, are just more of your day-to-day expenses. Is there anything that you're thinking about incurring, whether it's like a marketing spend or anything that you think, well, actually, if I did that now, and from a timing point of view brings it into the earlier periods, it's worth doing? If I'm going to make any capital disposals, when am I going to time them from a tax impact? Do I want to do it now and actually maybe pay some sort of corporate tax on your chargeable gains up front, or any personal tax on your personal gains up front, or do I want to defer them into a later period? And thinking about changing tax rates, what's more effective for you, really? Certainly from a business perspective, if you're doing any research and development type expenditure, well, R&D is a very sort of pertinent topical right now. There's been a bit of a change in the climate. I think there was a view probably a few years ago that R&D was sort of easy money, that you could put claims in and that you get some tax repayments back or some tax credits. Well, there's definitely been a shift in sort of the climate there, and HMRC's view on this. But that said, if you are undertaking genuine R&D type activity, and sort of measure of that in simple terms, if there's an advancement in science or technology, well, then you should be making a claim, and actually, that helps with the cash flow of the business if that claim is successful. So yeah, absolutely is something that you should be on your radar and thinking about when speaking to your advisor about is, am I doing this? When can I make a claim? What's my time frame? And getting that claim in, basically, and seeing it through. And as I said, again, a similar point, deferring income. Maybe we just, you might have a contract about, or you're pitching for a contract, maybe you might want to hold off and sort of agree final terms in the next period, just to push income into a later point, so you're not having to pay tax now when you could sort of defer the tax payment of that. Right, inheritance tax. So again, I've touched on this briefly. So the first point, I guess I've covered already, that change to business owners, moving from, I guess, effectively full IHT relief to sort of partial relief, and how you might want to plan for that. That's very pertinent, and it's something that everybody should be thinking about, especially as we move through the tax years. They kick in from April 26, but it's probably worth giving some thought now as to the impact of that for you. Unfortunately, the only really way you fall within the current rules is if you were to pass away before April 26. So if you try and take some action now to mitigate any of these changes, you get caught by sort of transitional rules anyway. So it's one of those that was brought in with no scope to really do anything about it. other than the thing that nobody wants to do. So that's a step too far to save tax, I think. But other things that are worth thinking about if you're in, I guess, the position to do so is gifts out of income or sort of normal expenditure out of income. So if you find that you have got excess income that you're drawing from your business or from other sources, and yes, you'll pay the tax on that, but you don't necessarily need it. What you can do is give that away, and that would be an exempt sort of transfer for inheritance tax rather than one that could be caught if you don't survive 7 years, which is called a potentially exempt transfer. This is an exempt transfer, so it just falls outside the scope of IHT. But to qualify as a sort of gift out of income, it does need to be excess income that, by giving it away, doesn't detriment the quality of your lifestyle, doesn't detriment, what you're doing day to day, I guess. And there has to be a regular pattern of giving and an intention that there's a regular pattern. So again, as an extreme example, if you did make a gift and intended to be a gift out of income and something happened to you and let's say it was fatal, that wouldn't mean it isn't a gift out of income. But in ordinary terms, if you set that intention and want to do it year after year, and you outlive these gifts and it does become a regular pattern, then that does give that evidence that that intention has been met. Now, the amount itself doesn't have to be fixed. It's just that intention to regularly gift out your excess income, but it is a very effective way of basically managing your exposure to IHT. If you don't need the money, clearly you might have been in a fortunate position to be in this category, but it's just worth mentioning nonetheless. And then more as a sort of basic point, actually, is the amount of people we meet that don't have wills is quite scary. Not as we always suggest doing it, but not necessarily just for tax purposes. Often you'll have a will just because there may be young children and you want to make sure that you've got guardianship in place if anything was to happen. But that said, if you do have a will, most people, if they have children, tend to want to leave a property to their child. And so if you structure your will appropriately, then in addition to the sort of standard nil rate band, it's called, for inheritance tax, which is £325,000 each, there's an additional residence nil rate band that's worth £175,000 each that you can qualify for on top. So all of a sudden, if they're as a husband and wife or single partners, and they leave a property to a child, well, they can have £1 million estate that's subject to 0% tax. So, but it's all about making sure your will is effective in that sense. So, definitely get a will, and if you do have one and your intention is to leave the property, have a look at whether it does qualify for the residence nil rate ban, because that is it's a relief you don't want to lose because it's readily available for the sort of ordinary person, basically. Right, last slide is property. So again, it's the sort of thing that might be more pertinent to the audience. If you've got joint ownership of a property, what you might want to do, the default position is that I've got joint property and you split income 50-50, but you can actually fill what's called a Form 17. And if there's any change to the beneficial ownership of the property, so let's say it was 75-25, then the taxation of the income would reflect that, not the default 50-50 position. So if you do have an asset, like we, going back to our previous slides about shifting assets between spouses, you might want to shift a percentage ownership within a property to go from 50-50 to 25-75. If you fill in Form 17, HMRC recognise that, and then the income is, or the taxation of the income follows the beneficial ownership. So that's quite important options available to you. Again, a main residence election, if you are lucky enough to have more than one property, thinking about which one is your main residence. Like, in simple terms, if you occupy a property as your main residence, then that property, on disposal of that, any gain is exempt from, or there's a relief available to mitigate any gain that arises. If there is more than one property, that you can only have one main residence. So if you elect for one property main residence, what that means is you're giving up the entitlement to that on another property, and it comes down to doing the maths about, well, which property is likely to be the most lucrative or generate the most gain ultimately. Which one would you want to be treated main residence? There is a bit around quality of occupation. HMRC could challenge it if, I don't know, one is really just a holiday home and one is your actual main home. But knowing that you can make a selection, it again is useful, but that election must be made within 2 years of a property change. So if you're past that 2 year, you can't then kind of switch properties in terms of elections. And if you've got anyone if you're disposing of a property that isn't your main residence, or even if it is, but you're expecting a gain to be realised on that property. A few years ago, there was a new requirement to report that disposal to HMRC within 60 days and pay like a prepayment of tax. Now that falls outside of self-assessment, but equally, it still has to be done. So if you are within self-assessment, it means you would have to do this standalone property return and then also report it on your tax return. But you do get credit for any tax paid under the 60-day requirement against your self-assessment liability. So again, just to be aware of that, a lot of people, it's not on their radar, and they find that they are disposing of property but not making the necessary reports to HMRC in time, and then maybe subject to sort of late filing penalties and so on. So definitely one to avoid. Right, enough of me chatting. Over to Steve for the case study.
Yeah, so I guess what we've done here is we've kind of gone through and pulled out a kind of typical example that we would see. So we've got a guy, Dave, married, two young children, runs his own business, kind of standard combination of salary and dividends. Youngest child's about to attend nursery. He's concerned about levels of outgoing going out the household, especially as he already feels like he's not being putting enough money aside for his future pension. So kind of standard scenario. We'll have this conversation with clients quite a bit. Dave's wife Dawn has not yet gone back to work, but lets out a property that she bought before meeting Dave. She is debating whether now is a good time to sell the property. So I guess you've got your standard scenario, husband and wife. Wife owns another property, which she might sell. So you've kind of got some considerations around that. And Dave, who runs a business, has got some outgoings. They're going to increase as kids go to nursery, but he's also got some concerns about pension provisions for the future and whether he's kind of got enough money when he does eventually get a retirement age. Edie's going to come on to some technical considerations in a few minutes, but I guess when I'm kind of met with this scenario, I always kind of start by chatting through kind of what is the actual practicalities of where you want to be. So I guess you can always go into the tax side of things and how to structure things in the most tax efficient way. But inevitably, what this always comes down to is like, pension is very tax efficient, but if you need a certain level of income into a household to kind of maintain a certain standard of life and to kind of pay the bills, well, pension's kind of off the table because it's something for a number of years down the line. So I always kind of sit down with clients and say, look, the key things are look at where you are today, look at what income you need in at the household, look at the kind of practicalities of day-to-day life, and then get into the tax as almost the second side of things. It is very much about that kind of cash in, cash out almost to start with, and then work back to the tax side of things. This is a pretty common scenario, and I guess especially in smaller businesses, what you see a lot is the business and the individuals very much are kind of one together. You have got to be aware that there is tax consequences, but they kind of go hand in hand. If in this scenario Dave needs more cash, well, it probably comes down to the business has to perform better, has to generate some more income. There's considerations there. So a lot of the time, like I said, we'll sit down, we'll have this conversation, we'll kind of assess the level of income that is needed. We'll then kind of map that and overlay that over the business, over some forecasts that the business has done. Adie's kind of mentioned a few of the things that the national insurance contributions going up, corporation tax rates have recently gone up. So we'll kind of overlay all of that, map it all out, and see whether the business can then sustain the level of income that the individuals need. And then once you've kind of got that high level overarching plan, you then drop into right and how do we structure that most tax efficiently for husband and wife, kids, and then into the kind of nice to haves after that, company vehicles, pension contributions, and then all of the other kind of peripheral items Adie's mentioned. And I guess that's the kind of methodology we work through from it because if you start with a tax but there's no income there anyway, it's kind of an irrelevant process to go through. So yeah, Edie, do you want to drop into some of the more technical bits that you would probably cover in this scenario?
Yeah, absolutely. So I think, look, this was just again drawing out a lot of things we've covered. The fact that we've got a business owner and we've talked about dividend salary. Yeah, so there's going to be some considerations around what's probably the optimal position for me. But again, what that will be will sometimes differ depending on the situation at hand. It's not always black and white, that right, draw that minimum level of salary and the rest with dividends. Again, there might be reasons why you need to take more income. It may be for lending purposes, it might be for your pension purposes, it might be the business doesn't have scope to make as much contributions as you like, but you might have scope yourself, but you need the earnings to demonstrate it. So yeah, it's not always black and white. You need to think through each situation independently. The children aspect was more around this 100k threshold. So the simplest way of thinking about it is 100k of earnings. It's not quite as simple as that. It's called adjusted net income, but essentially it's your earnings less pension contributions dictate whether you've got 100k of adjusted net income. And if you breach that, then you lose your entitlement to tax-free childcare. So there's a bit of a government top up to cash funds, and separately you get these free childcare hours, and again you lose entitlement to that. So a lot of people that we deal with who are in control of, I guess, their income streams don't necessarily need to draw more than 100k, or kind of cap themselves at 100k there or thereabouts. So they've got sufficient amount of income, but equally some of the sort of tax benefits that come or that arise from having children, they don't want to lose out, because that will ultimately become quite costly. And that's then married also in terms of if you breach that 100k limit, you start to lose your personal allowance, and then you get that effective 60%. So in this scenario, we'd probably suggest managing income if they can at around 100k or less, and therefore retaining those tax benefits that support your children at nursery for the years they're there. You might change that down the line once the kids are in school, but for a few years it might be an important consideration. In terms of the property, again, it's about, well, what is Dawn, the wife, trying to achieve? Does she need the income from that property? If she does, then clearly things probably won't change. She'll keep hold of it. But if she's thinking about selling it, if there was another third party, does she want to transfer a share in it and maybe mitigate her income? Or if she's going to sell the property, well, she's got the 60-day reporting requirement. So let's, make her aware of that. Is there liability on it at all? You need to work through the process. So it's just like I say, this, as Steve's mentioned, this is just kind of a few pointers, but just adding to Steve's message, when we do speak to people, whilst there are lots of tax issues that come out, it is understanding people's bigger motives. Like, tax is a factor in what you're trying to achieve. It shouldn't necessarily drive what you're trying to achieve. Sometimes it will. Sometimes tax will be the primary focus, but often we start with a conversation with clients around, a tax matter, but actually it's the bigger, broader discussion that becomes more important, and then tax will feed into that. And actually you'll start looking at certain points, but those points will feed into a bigger plan. So I think, again, if we think about preparing for a new tax year or so on, actually it's about having a bit of a plan of what you're trying to achieve longer term, and then taking some steps within that to meet that plan as efficiently as possible. I think, that's a good sort of train of thought, really. Just to finish off, we've talked about looking forward to a tax year. We've talked about very sort of specific tax points, but just to put on your radar some of the things that come in. So, we're shortly into the 25-26 tax year. I've just touched on that 100k earnings threshold, important for a number of reasons. So, it's good to be on your radar and give some thought to that. But we've got this increase in the business asset disposal relief rate of CGT. That's gone up to 14% from the 6th of April this year. Looking a year ahead, we've got Making Tax Digital from April 26 is kicking in. So it's starting off with basically individuals that have income from self-employment or property income that exceeds 50,000, but that's going to fall. So look, Making Tax Digital is coming for everybody. Ultimately, it's been a long time coming, and what it will mean is that those that are impacted will kind of make quarterly submissions, and then a final submission, which probably will be by way of the tax return, albeit can be outside the tax return if they're not in self-assessment. But it's just basically meaning that you're going to be making much more timely filings to HMRC of your income. And the intention is that works for you and HMRC. HMRC get visibility on tax receipts up front, I guess, and you should have a better feel for what your liability is going to be. But it will put more of an onus on taxpayers, I think, to work with advisors, or at least take it on themselves and make filings on a more regular basis rather than perhaps once a year. So yeah, watch the space on that. There's going to be a lot more noise around that in the next sort of 6 months. The changes to business relief we've touched on, which is the IHT changes for sort of business owners with shareholdings in unquoted trading companies. So yes, that's kicking from April 26. And then we've got that further increase in the tax on business asset disposal relief. That's up to 18%. And then from April 27, just as a sort of double whammy, what came out of the budget was, so pension funds will fall within the scope of inheritance tax. So historically they haven't. They've always fallen outside. And I think people with sufficient levels of wealth have kind of used them as a store of wealth and never really touched them. Whereas I think the attitude to that is going to change. That the government view is pensions are there to be used. They're there to provide for your, when you are in retirement, and should be drawn upon. So therefore, if they're not, they will be caught when you die, and from an inheritance tax point of view. So yeah, I think we'll start to see how pension funds are used a bit differently, but it's just putting on your radar that maybe any expectation that these are very IHT efficient. They are currently, but unfortunately from April 27, that's going to change. So that's it for us today. Anything you want to add, Steve, before we go? Or
No, I think that's it. Lots of information there, really. So thanks for running through all of that. And yeah, thanks very much, everyone.
thank you. Thanks, everyone.